Hi guys, a very good evening to each and everyone. I say Rahul Garg, welcome all of you to my YouTube channel in which our Manzil batch is going on, and today is the session number 4 of our costing subject. As you all know, we have been taking this batch specifically for the MCQs, as the MCQs have become an integral and important part of the questions under the new syllabus. So we have been taking the Manzil batch for all of our subjects, that is advanced account costing and FMSM. And in the previous 3 sessions of costing, we have done majority of the chapters, and today session number 4 will mark the end of our costing subjects. We were left with the 3 chapters which we are going to do today. So if you have reached the channel guys, please hit the like button and also do subscribe and press the bell icon so that you don't miss any future update. With this, I will take immediately all of you to the main screen. Okay guys, so as I said, we are on the session number 4 of the costing subject today, and it is a totally MCQ focused batch. The notes which you are seeing on the screen shall be shared on the Telegram channel after the session will end. Okay, so you have to concentrate only on the screen, and preferably if you are having your calculators in hand, that will be so nice. That will be so nice, so that you will be able to do the calculation side by side, and you will also be able to do some brainstorming whether out of these 4 options which one is going to be the correct answer. Okay, so let me move ahead quickly. As I said, today is the session of the subject costing, and it is our session number 4. The left out chapters which were not covered in the earlier 3 sessions, we are taking this today. So first is the process costing, then standard costing, and the last one will be the marginal costing. So we'll be doing the MCQs of all these chapters. I have incorporated the mix of theory questions, practical questions, and even the case study type questions in this particular session. Come on guys, come on guys. Okay, come on guys. The first one, so the student is joining us from the Rajkot, where we had a memorable session for 2 days. Come on, Ji. Question number 1, guys. So you should be ready to hit the correct answer, and you can also participate in the chat section by saying the correct answer. So it says the cost of normal loss is the cost of normal loss. Which chapter it is talking about? When you will be sitting in the examination, obviously you will not be able to get first of all that it is talking about which particular chapter, but we know that we are talking about these 3 chapters, process, standard and marginal. If out of these chapters, these 3 chapters, I have to pick up the best one for this type of question, it will be the process costing. But yet let us read the options. So the first one says the cost of normal loss is treated as a part of cost of production. So you tell me whether it is correct or not. Absolutely correct. The cost of abnormal loss is taken to costing P&L, but the cost of normal loss is treated as a part of cost of production. So this seems to be correct. Then it says is absorbed by good units. Now this is also correct, but we know that only one option can be correct. So we will have to wait and have to read out the further options. The third one says it is charged to costing P&L account. So this option is wrong because this is true in case of abnormal loss. And the last one says A and B both. A and B both. So yes, this is our correct answer. This is the correct answer. The cost of normal loss is absorbed by good units, as well as it is treated as the cost of productions. So A and B being the correct answers, and the most correct option will be option D because it includes both A and B child. Wait, so I'll take it as a whole. Okay, na? So I keep marking the correct option with this pinkish type of color, so that when I share the notes in the Telegram, by just looking at the question, you will be able to see the answer, and that will be of immense help at the time of examination, child. Moving ahead. So question number 2, it says 200 units were introduced in process. Okay, they introduced 200 units. 20 units is the normal loss. If the actual output is 150 units, then there is. So question is asking whether there is abnormal loss or gain, etc., etc. So it can be done like this as well, or you can make a rough process account. So question says 200 units were input in the process. Okay, 20 units is the normal loss. We know it is taken to the credit side. Question says the output is 150 units. So you tell me where is the balancing figure? The balancing figure is appearing on the credit side of 30 units, and we know this is abnormal loss. Or you can see in a very simple manner, out of 220 is the normal loss. So my expected output would have been 180, whereas the actual output is only 150. So balance 30 units represents the abnormal loss. So the correct option being child, the abnormal loss of 30 units. Okay, should be comfortable. Moving to the next one, that is question number 3. So it says, which of the following doesn't appear on the debit side of process account? We know in the process account on the debit side, we mainly put the expenses plus there can be the abnormal gain. So question says, which one doesn't appear? Cost of material, it appears, so it's the wrong option. Cost of labor, it also appears. Normal loss scrap, no, it does not appear. So this becomes the correct option. This becomes the correct option. D, direct expenses, it also appears on the debit side. Question has asked me which one doesn't appear. So normal loss scrap because it appears on the credit side, child. Okay. Okay. Next one. Question says, the product of a manufacturing concern passes through two processes A and B and then to the finished stock, a usual feature in the process costing. So from process A to B and then B to finished stock. It is ascertained that in each process, normally 5% of the total weight is lost. So it's a normal loss. Any loss which you already know in percentage is certainly the normal loss. It says 5% of the total weight is lost. You already know whatever weight you input in the process, the 5% of that shall be lost. Weight is lost means it is just like evaporation. So can there be any scrap value of this? No, there can't be any scrap value of such kind of normal loss in which the weight is automatically lost. It says 10% is scrap. So 10% is scrap means this is another kind of normal loss. So there are two normal loss in the question. This is scrap from which the process A and B realize 80 and 200 per ton respectively. So the scrap of process A can be sold at 80 and the scrap of process B can be sold at 200 per ton. It says the following are the figures relating to the two processes. So the data being given for the both processes, child. Question says material in tons is, for the first process you input 1000 ton and the cost of material per ton is 125. So 1000 into 125, total input of 1,25,000 is being put. Wages 28,000, manufacturing expense 8,000, both to be debited. It says the output is 830. So what we will do, we will first of all consider this 5% and 10% is the normal loss, and after that the output is 830. So balancing figure we will be able to get it as the abnormal loss or the abnormal gain. Similarly, certain data for process B is given. Question says there is no stock or WIP. Answer question number 4 to question number 7. So obviously we will have to prepare the process accounts in detail and after that only we can get the answer, but yet still we will see what kind of questions it are being asked. It says what's the cost of abnormal loss from process A. So to find the cost of abnormal loss, you will need to prepare the process account and then we'll have to find out the cost per unit. So we will multiply the abnormal loss units with that cost per unit. Okay, so I will show the detailed answer to this question over here. We have done it in detail. Child. Please see. So first of all, as I said, process A account we are preparing. Question says 1000 unit of material and amount being 1,25,000 at the rate of 125 per ton. Wages are given straight away 28,000. Manufacturing expenses are given 8,000. In the normal loss, there are two categories. So question said there is a weight loss of 5%. 5% of what? Of this input 1000. So 1000 into 5% gives us 50 units, and obviously there is nothing in amount because there is no scrap related to it. There is another kind of normal loss named as scrap where the normal loss occurring is 10%. So you have to do 1000 into 10% means 100 and the rate of scrap was 80 per ton. So 100 into 80 will give you 8000. And question said the process B means the units transferred to next process are 830. As soon as you get this, the total of the units on debit side is 1000 and on credit side obviously it has to be 1000. So you see there is a balancing figure of 20 units abnormal loss on the credit side. Whenever there is a balancing figure on the credit side, it has to be the abnormal loss, so 20 units. Now to find out the cost per unit, we apply the basic formula, that is total cost debit in process to be reduced by the scrap of the normal loss, which is 8000 rupee, this one, divide by total units you did input, that is 1000, and minus the normal loss units, which are 50 and 100. So you get these values and the cost being rupee 180 per unit. So abnormal loss 20 units when multiplied by 180 will give you 3600, and the amount of the units transferred to process B 830 multiplied by 180, you will get 149,400. Let us go back to question. Let us see what was being asked by question. What is the cost of abnormal loss from process A? So we have found this correct answer as 3600. Okay, then it says what is the cost of output from process A? When we prepared the process account, the cost of 830 units. When it says cost of output means the cost of those 830 units. So that is 1,49,400. So these two questions could be answered only after preparing the process A account, child. Okay. Okay, then it says find the value of abnormal gain in process B, means we will have to prepare the process B. So the output which is of process A shall become the input of process B, plus additionally question is giving this data. So it says you input another 70 ton of material in process B at the rate of 200. So 70 into 200, 14,000 rupee of fresh input is being put in process B. Wages are there, manufacturing expenses are there, and the output is 780. Anyhow, let us move over here. So first of all, the output of process A, which was by process B, so process B will welcome, it will say to process A account 830 units and 149 400. Then other than that, question said there will be an input of 70 units of material fresh at the rate of 200, so it will become 14,000. Wages are 10,000, manufacturing expenses are 5250. Coming in the same manner for the normal loss, 5% of the total weight is lost. So the total weight is 830 plus 70 means 900. So 5% of that becomes 45 and the scrap is 10%. So 900 into 10% becomes 90. The question said the rate of scrap is 200 per ton. So the amount becomes 18,000. Question said the output is 780 units. Now you see on the debit side your total units are 900, whereas if you do it on the credit side, the total is much higher, that is 915. So we will put 915 on the debit side as well, meaning thereby there is an abnormal gain of 15 units. So this is the first thing which is important. Okay, then question said to find out the cost of abnormal gain, the value of abnormal gain. So the same formula, total cost debit in process minus the scrap of normal loss which was 18,000 upon total units input which were 900 minus the normal loss units. So by doing this we get a value of 210 per unit. You multiply this 15 by 210, you get the value as 3150, and in similar manner you multiply it by the 780 complete units, you get the value 1,63,800. Okay, let us go back and see what are the questions being raised. So first one was find the value of abnormal gain. So we just found it as 3150. Then what is the cost of finished stock? We also found this out as 1,63,800 child. I hope it is absolutely correct. There should not be any issue in this. Okay, ji? Okay, ji. Next question, question number 8. So we did 7 odd questions from the process costing. Now we are moving to the standard costing questions. Okay, if standard hours for 100 units of output, standard hours for 100 units of output are 400. So standard hours basically are 400 and the rate is rupee 2 per hour. Done. Actual hours taken are 380 and the actual rate is this. Then the labor rate variance shall be. What will be the labor rate variance? So labor rate variance is simply you have to take the actual hours, that is 380, multiply by your standard rate was rupee 2, whereas you have paid 2.25 paisa, means you have paid 25 paisa more for this. So 380 into 380 into 0.25, you get 95 rupee, and that on the adverse side. So 95 adverse is the correct answer. This detail is irrelevant. Now when sitting in the examination hall, you will not be able to figure it out. The mind will say do something with this 100 unit, do something with this 400 hours. These are irrelevant detail because we have to see what is being asked by a question. Labor rate variance, then you have to go backwards and check what is the relevant info which you require for this labor rate variance. So we need actual hours which is 380, actual rate which is 2.25, and the standard rate which is 2 rupee, and you will be able to get the answer easily. Okay. Okay. Moving further, it says dash refer to the expression of standard in units or hours. When we do the theory of the standard costing chapter, we see the standards can be expressed either in price terms, rupee terms, or in physical terms, that is units, hours, etc. So what is the technical name for expression of standards in units or hours? The various options being given: physical standard, price standard, normal standard, none of the above. The correct answer is child physical standards. This is the correct answer. Okay, if it is said that the standards are being expressed in rupee terms, in that case the answer could have been price standard, which is written in option number B. Okay. Okay, so this one is again a wonderful question. This one is again a wonderful question. Let us see. It says the following data has been collected from the cost records of a unit for computing the various fixed overhead variances for a period. In the standard costing chapter, the most important variances are either the material or the fixed overhead. So the question relates to the fixed overhead variances. It says budgeted working days are 25, budgeted man hours per day. So there are 25 days as budgeted, and in one day budget is to work for 6,000 hours. Output budgeted per man hour, and in 1 hour you expect to produce 1 unit. So this is budgeted again. Fixed overhead cost as budgeted 1,50,000. So this is all the budgeted data. Now it says actual days we have worked 27, actual man hours per day have been 6,300, and in 1 hour the actual output has been 0.9 unit. Actual fixed overhead incurred have been 1,56,000. So this data is all about the actuals, whereas the above four lines, above four rows represents the data with respect to the standard. So question says to us, from the above details you have required to answer question number 10, 11 and 12. We have to answer 3 questions. So it says what's the expenditure variance, then it says volume variance and cost variance. Now if you are my student, if you are watching the lecture and you have taken the classes from me, either regular or fast track, you know our way of doing the standard costing is different. But yes, even if you have not taken the classes from me, you must have done this chapter somewhere with your tuition teacher, etc. In that case, please solve this question as per your technique, and your answer should match with my answer. As far as our technique is concerned, we do the models approach, in which there are 5 steps for fixed overhead variances: FO1, FO2, 3, 4 and 5. Okay, so if I say FO1, this is our FO1 actual fixed overhead, this is our FO2, that is fixed overhead budgeted. Okay, if I say what is the formula for expenditure variance, the formula for expenditure variance is FO2 minus FO1. So I have FO2 is 1,50,000, FO1 is 156. So 1,50,000 minus 1,56,000, you get 6,000 adverse as the correct answer. So I get this answer straight away, 6,000 adverse. Or if you want to show it in detail as well, so FO2 is 1,50,000, FO1 is 1,56,000. So it's very simple. You expected your budgeted fixed overheads to be 1,50,000, whereas you spent 1,56,000. So you spent 6,000 more. So obviously there is an adverse variance related to this one. Next, it says what is the volume variance? Now the volume variance as per our technique is measured by FO5 minus FO2. So we have FO2, that's no problem. But what is FO5? So the FO5 is basically related to the output thing. So what is your actual output? What is the actual output? It said actual output per hour is 0.9. So what are the hours? These are 6,300, but these are per day. So you have to find actual hours first of all. 27 into 6,300. 27 days you have worked, and in one day you work 6,300 hours. So these are the hours, and in 1 hour you produce 0.9 units. So actual output multiply by budgeted fixed overheads divide by budgeted output you have to do. What is the budgeted output? So you had to work for 25 days. In one day you had to work for 6,000 hours. So 25 multiply by 6,000, you get total hours in the month, and then for 1 hour you could have produced 1 unit. So in denominator you will have your budgeted output. So if we see 6,300 into 27 into 0.9, this value get is 153,090, and this is 1,50,000 divided by 1,50,000. So this gives you basically the standard fixed overhead per unit of output. You produced 153,090 output, and as per the standard rate, your total expenditure for the output should have been 153,090. 153,090. So when we say volume variance, we have FO5 as 153,090, whereas this is 1,50,000. FO2 we have already marked it. This is 1,50,000. So you get the variance of rupee 3090 favorable. The correct answer being child option B. So if you are well versed with the formulas, etc., you should be able to do any kind of question when you encounter in the examination. Moving further, it says one more question. What is the cost variance? So cost variance is measured by FO5 minus FO1, means what is the overall variance? So we just found out our FO5 is 153,090, FO1 is 1,56,000. So the variance will come out to 2910 adverse. 2910 adverse. So the correct option being this A option. So it has to be solved in this particular manner, child. Should be comfortable. Should be comfortable. Okay, now we move to the questions of the chapter marginal costing, which is again the very good chapter. So it says the main difference between the marginal costing and the absorption costing is regarding the treatment of. When we do the chapter marginal costing, we encounter one topic is absorption costing versus marginal costing. So what is the main difference between the two? The question says, is it prime cost? No. Is it fixed overheads? Yes. Is it direct material? No. Is it variable overhead? No. The answer is fixed overhead. The treatment of fixed overhead is different in both the marginal and the absorption costing. Okay. So this is a tricky one in the sense you have to apply a little bit of your mind and do the brainstorming. PV ratio can be improved. What is the formula for PV ratio? Formula for PV ratio is contribution upon sales into 100. So when we say how to improve the PV ratio, means you have to increase your contribution, and we know contribution is measured by sales minus variable cost. So even if you reduce your variable cost, in that manner also you can improve the PV ratio. So first one says reducing the variable cost. Yes, this option seems to be correct. Second says reducing the selling price. No, if you reduce your selling price, your contribution etc will also fall. Reducing the fixed cost. When we say how can we improve the PV ratio, the fixed cost is irrelevant because it doesn't enter into the calculation of PV ratio. Increasing the variable cost. No, if you increase your variable cost, your PV ratio will not improve, it will decrease further. So this is again the wrong option. The correct option being the option number A, that is reducing the variable cost. This is the correct option. If you reduce your variable cost, your contribution shall increase, and when contribution increases, obviously your PV ratio shall improve. Again a wonderful one. The angle of incidence is formed by intersection of sales line and dash line at the break-even point. So it's not a rocket science if you know what's the meaning of break-even point. So break-even point is the point, sir, at which there is no profit or loss. Sir, profit or loss is equal to 0. Why? Because total revenue is equal to total cost. Now total revenue is nothing but the sales, and the total cost means the sum total of fixed and variable. So the option of fixed cost, variable cost are irrelevant. These are wrong options. The correct option is total cost. So angle of incidence is formed when your total revenue, that is the sales line, matches with the total cost line, where when they intersect, basically at that point the angle which is formed is known as the angle of incidence. That is known as the angle of incidence, child. Okay. Okay. Again, so once again a wonderful question. This question has been asked in the examination. Very wonderful one. We will see. Question says A Limited maintains margin of safety of 37.5%. Whenever the question says you the MOS is this percentage, you should immediately know what does that mean and what can you deduce from this data. We know that the sales line, the total revenue line, is having only two portions. One is the break even and the other is the margin of safety. So the total of break even sales percentage and the margin of safety percentage is always equal to 100%. When question says it maintains MOS of 37.5%, it simply means when you deduct it from 100, so 100 minus 37.50%, it gives you 62.50%. So this is my break-even sales percentage. It simply means out of total sales done in the year, 62.5% is break-even, and after that whatever you want represents the MOS. Further moving, it says with an overall contribution to sales ratio of 40%. Now what is this contribution to sales ratio? It is another name for the PV ratio. So your PV ratio is 40%. Question says fixed cost are rupee 5 lakh, and with this info we are required to give the answers of question number 16 to 20. Okay, so first says calculate the break-even sales. We know the formula for break-even sales is fixed cost divided by PV ratio. In this question we have the fixed cost as child rupee 5 lakh and the PV ratio is 40%. So 5 lakh divided by 40% gives us 12.5, means 12 lakh 50,000 rupee. It is the correct answer. Fixed cost divided by PV ratio gives us the correct answer. Next, what will be the total sales? So it says what will be the total sales. Now we have got to know that boss, break even sales is 12.5 lakh rupee. Also, while reading the question, I told you that break even is 62.5%. Also, we know that break even sales represent 62.50% of total sales, and the question has asked me total sales. So, by the reverse formula, I can say total sales is equal to 12.5 lakh divided by 62.50%. It gives us 20 lakh rupee. So 17th question, correct option is option number C. This becomes the value of total sales. Don't worry, I have been solving in a shortcut manner as is required for you to solve in the examination as well, but for the detailed clarity, I have given the solution of this question in detail. When you want, you can refer. Similarly, the question which was relating to the standard costing fixed overhead variances, I have given the answer of detail. I've given the answer in detail of the steps, that is FO1, FO2 and FO5. Plus for additional knowledge, I have given this FO3 and FO4 as well, in case you want to solve the other variances, calendar, capacity and efficiency. So you will need this step FO3 and 4. So I have given that as well. Okay. Question says find out the total variable cost. Now you are having the total sales as 20 lakh rupee. The PV ratio was given as 40%, and we know the total of PV ratio and VC ratio is 100%. So first of all, I can say that variable cost ratio is 100 minus 40%, that is PV. So VC ratio is 60%, and as the total sales we just found out is 20 lakh. So 60% of that 20 lakh becomes child 12 lakh rupee. 12 lakh rupee. So it becomes the correct answer. Which one? The option number C. 12 lakh rupee becomes the correct answer. Just hold a second. Yeah, moving further. So it says what's the current profit? So there is a simple equation for the profit which we know. We can say sales multiplied by PV ratio, which will give us the contribution, and out of that if I reduce the fixed cost, I will get the profit. So your sales is 20 lakh, your PV ratio is 40%, meaning thereby contribution is 8 lakh. The fixed cost is given as rupee 5 lakh. So 8 minus 5, you get a value of rupee 3 lakh. So 3 lakh rupees are current profit, child. Again, done. Last one says what will be the new MOS? So it says me new margin of safety if the sales volume is increased by 7.5%. So as of now, what is your sales value? My sales value is 20 lakh rupee. Okay, I'll show you it over here. I've done it. Okay, so this black line, if you see from this point up till this point, is my current sales, out of which this particular portion is break even point and the further portion is MOS. Now once your break even has been done, any sales which you earn after that is MOS. Now question says what will be the new MOS if we increase the sales by 7.5%. So basically the sales is being increased by this. So it's very simple, whatever the addition is being done, this will be the addition to the MOS. This will be the addition to the MOS. So question said me find out the new MOS, means anything beyond break even is the MOS. So existing MOS, which was 37.5% of the sales, plus now 7.5%, which is being added to the sales. So total sales are 20 lakh. Question said me in the starting when we were reading the question, 37.5%, 37.5% is the MOS. So current MOS is 7.5 lakh plus additional MOS is 7.5% of the sales, that is 150. So total being rupee 9 lakh, child, and we will mark the correct option of rupee 9 lakh, which is option B. Which is option B. So these were the questions for the today's session. I hope everybody has enjoyed who have been associated, and with this our session ऑल द सेशंस ऑफ कॉस्टिंग आर कंप्लीट। हाँ जी, इसी के साथ कॉस्टिंग के सभी चैप्टर्स हमारे, हमने 4 सेशन के अंदर समेटे थे, सभी के सभी चैप्टर हमारे होते हैं खत्म। मैंने बताया था एडवांस अकाउंट के कुल मिलाकर 6 सेशन हैं, एफएमएसएम के 5 हैं और कॉस्टिंग के 4 सेशन हैं। तो भाई कॉस्टिंग के 4 सेशन कंप्लीट हो गए, एडवांस के हमारे 4 सेशन ऑलरेडी हो चुके हैं, 5वां सेशन अभी यूट्यूब पर आ जाएगा जैसे ये सेशन एंड होगा इसके 2 मिनट के बाद, ठीक है। और एफएमएसएम के भी 4 हो चुके हैं। तो आज के बाद एडवांस अकाउंट का लास्ट सेशन रह जाएगा, सेशन नंबर 6, और एफएमएसएम का सेशन नंबर 5, जो कि आने वाले दिनों में हम फटाफट से कंप्लीट कर लेंगे, ठीक है जी गाइस। सो इसी के साथ आज का सेशन करते हैं समाप्त, मुलाकात करते हैं आगे जी, बाय बाय।